It's me. We're back. I hope you guys enjoyed lunch. We got a couple more panels before we close for the day. This one is going to be as exciting, if not more exciting, than all the ones this morning. So this one is called Beyond the Cycle, How Smart Capital is Positioning for the Institutional Era. We have great speakers from places like Dragonfly, Foresight Ventures, Further Ventures, Sygnum Bank, and the moderator in this case is a good friend of mine, Pet from Tokenized. Please welcome our speakers and moderator.
Hello and welcome everyone. Luckily I'm not on my own, otherwise I don't think the room would be as full. Joined by a fantastic panel of guests. First and foremost, my name's Berisha. I run the Tokenized Podcast, which a few people in the room have said they listen to, which is awesome. And joined by someone I've shared the stage with before, Rob Hadick, GP of Dragonfly. How are you?
I'm doing great.
Yeah, nearly just got stuck in the lift on the way down here, so thankfully we made it. Also joining us, Alice Lee, partner at Foresight Ventures. How are you?
I'm great, yeah.
And Robbie Nakarmi, GP at Further Ventures.
Nice to meet you, and very happy to be here in Amsterdam.
And then I'm going to try it. Sai Agnikhotram, SVP bank-to-bank banking at Sygnum Bank.
Fantastic. Thank you.
How many times can you say bank without getting it wrong?
Sorry?
How many times can I say bank without getting it wrong? I was more worried about that than your second name, to be fair. Listen, Rob, I want to start with you. Give us the kind of state of the market as it comes to VC deployment. I mean, back in the speakers lounge, we were kind of talking about how it's skewing way more equity, less token, and that's a reflection of where the money is pooling right now in the institutional world.
Yeah, I think in the crypto VC world, and so Alice and I are crypto VCs. Further Ventures does as a broader mandate, of course. But in the crypto VC world, there's really been a big change over the last, call it 18, 24 months. We were talking a little bit about our funds at Dragonfly. And so Dragonfly, we're currently on our fourth fund. We've been investing out of this fund for a little over a year. And I was comparing our third fund, which was the 22 vintage, to the fourth fund. And we probably went from 60 to 70% tokens in the third fund to probably 10 to 15% right now in the fourth fund. We've always been big investors in things like stablecoins and tokenization and institutional adoption, but that has become even a bigger theme, and the checks have gotten bigger. So we actually made the biggest investment we've ever made into a business called Rain last year, which is a stablecoin card issuing business. And it's really not just us. We've started to see that, I think, take hold across the entire industry. People have slowed down a little bit. The seed market, I think, actually really slowed down for a little bit of a period of time. Maybe that's picking back up now. And we've seen people kind of concentrate into the winners. I expect that to continue to happen as the token market continues to bleed out. I do think we're probably near a bottom, and I don't think how bearish people are can continue to go on for that much longer. But I do think that crypto has become kind of a tale of two worlds, which is a retail market, which is sort of shrinking right now, and an institutional market, which is growing, honestly, quite quickly, and we're starting to see permeate all parts of the global economy.
Robbie, I'm seeing you nod your head viciously there. Anything to add on to Hadick's great points there?
Rob is a good friend, and we've worked on stuff before, and I generally really enjoy Rob's takes, especially when he starts fighting with people on Twitter. I would broadly agree with that. So. I would broadly agree with that. I'll just add, from my side, as Rob mentioned, Further Ventures has a relatively broad mandate in financial services, crossing fintech as well as crypto. And what Rob has said, we have broadly seen as well. You can see when you visit conferences, Consensus, for example, both in Miami and in Hong Kong, retail events were sparsely attended and sentiment was pretty bad, but institutional events were extremely bullish. Everyone there was not just looking at it as, oh, this is an interesting novelty. They were seeking out real partners to do actual deals, to complete actual mandates for deployment, which was very different to previous years.
I wasn't there at Consensus Miami, but a lot of people told me that people were dressed like Sai rather than dressed like me. So I guess that is an indicator of where we're going. And Sai, I mean, attending these conferences, from your perspective where you're sitting, How different is the conversation compared to even 18 months ago, 24 months ago?
Not sure if the attendance of folks like myself is always a good thing. Maybe it's a matter of dress code, but I digress. The conversation has shifted, and I think very fundamentally, very much echoing what you mentioned, right? It's this institutionalization of crypto, broadly speaking, where in the past, and just to give a little bit of context of what we do, because we're not obviously an investor, we enable other institutions to get regulated access to crypto. And so my typical counterparty is a bank who's trying to leverage many of these financial technology providers who are really trying to bridge the gap between traditional and digital asset, right? So what we see specifically with them is that they've gone through the whole sort of phase of discovering digital gold, to then seeing the picks and shovels that have been created, to now seeing the infrastructure providers. So what's really remaining and what they're looking for is really the plumbing. So you have stablecoins, you have tokenized assets, you have all of these elements which they know who the counterparty is and what the use case may be, but how to make it settle on the core banking system or order management system and make sure you can reconcile it in your traditional means is very difficult. So really counterparties that are doing the plumbing, which is obviously less luxurious, are really getting the sweet spot of a lot of the action. And then if you extrapolate that a little bit further, maybe 1 or 2 or 3 or 5 years further, you see this sort of consolidation of, let's say, even the custodians who are becoming commoditized. And so what you really have is the need for not only the plumbers, but also somebody who is doing the orchestration. And I think this is really the sort of pain point that we see and the discussions that we see now that are emerging and arising and everybody trying to solve these challenges, because ultimately there's no counterparty that can do that. So the discussion is very practical, and I really love that right now.
Alex, are you seeing the solutions or potential solutions to some of the things that Sai just mentioned reflected in the deal flow you're getting right now?
Yeah, it is. Another thing I wanted to add more color in is like the institution versus retail flow, because I travel in between New York and Singapore and Hong Kong. So I definitely agree there are more institutional participation in all of those events and conferences around the world, right? We don't see much retails in US and Europe anymore, but still some of the events in Hong Kong, in Singapore, retails are well attended, especially the ones like Consensus and also Hong Kong Web3 summits. That's where you see a lot of the retail users and retail parties will take place, especially for the centralized exchanges. So the most popular ones are OKX parties, Binance parties, and BitGets party. So that's where you feel like, everyone is very excited in the US about the regulatory changes and all the institutional participation. And a lot of the retail and buying power actually emerge from all the centralized exchanges. So that's like a very different scenario that we feel. And a lot of the innovation actually happens in the retail level inside of those centralized exchanges. Well, I'm not saying that because I'm the family office of Big Exchange, but I do feel like the retail's focus has been taken by a lot of the centralized exchanges nowadays, because we definitely talk to a lot of KOLs, talk to a lot of the communities. So whatever new product comes out, our users are happy to try out. So that's how we see the market. It's very interesting stages right now.
I think Alice's point is correct, but I also think it is actually harkens back to like what crypto used to be, which is that it was actually a very Asian-driven culture, Asian-driven retail business. And I was on the first working group at Goldman looking at crypto in 2014. And we were talking about tokenization of assets in 2014, and it was the world that is happening today. It was something that we thought would happen back then. It just took longer, and so it's almost as if it is the same as it was then. And so we've kind of come full circle. But I think the other main point to talk about here is, in BitGet's case, they launched the universal exchange, and a lot of the focus has been on now not just trading Bitcoin or Ethereum or Solana, but also trading tokenized assets, tokenized stocks, tokenized commodities, and like a much broader set of types of assets. And so I think the whole world seems to be sort of converging on, crypto and just like tokenized assets and capital markets are sort of going to be the same thing. And we're going to bring those things together in both retail and in institutional form factors. And they're not going to necessarily exist, I think, separately for that much longer.
And to add to these great points from my fellow panelists, retail hasn't disappeared. They are busy trading semiconductor stocks on leverage. So I do have this kind of inkling that eventually when we do have a cool off on the everything AI and GPU rally, as much of a secular trend that it is, that I'm sure is going to go up and to the right. Retail, has a tendency to chase green candles, and we've just seen a lot of red candles basically in crypto. So they've kind of lost interest. I do think there's a possibility some of that capital, especially prosumer traders, may rotate back to crypto once AI-driven stocks are exhausted.
I think there's also been kind of finally a decoupling where crypto has found more than one product market fit, which initially was just like trading assets, right? So stablecoins and I think prediction markets you could probably call the third, and perhaps that's also taken some of the shine off, just spot bids, right? Like if you
it's definitely taking volume from spot,
yeah, especially from like meme coins, which were definitely very retail driven. I think there is the kind of like meme coinification of a lot of these prediction markets, which again I think will probably whittle away down the line. But I wanted to ask you, Alice, how much of the deal flow that you're seeing now is concentrated in those vectors, right? It's either stablecoin RWA focused or prediction market focused, because I feel like almost all the attention is gone in that direction right now.
Yeah, I think mainly all the deal flows are either stablecoin, prediction market, or, more to add AI. That's also an interesting trend. I wanted to add one more thing, one more data from our perspective, is like we see the crypto trading volume in our exchange, right? It's actually going down for sure because there's not enough like price volatility, and it's like keep going down, but the RWA trading volume is going up it's now constitute 40% of BitGet's total spot volume, and it's still growing. So we see like there's a reason why people are like love to trade stocks, right? Love to trade all the oil or the silver, copper, or even future, not just spot. So that's why we see a lot of the companies that are doing RWA much more than before. And because we see real product market fit and the real retail demand from this trend. But the thing is, like for all kinds of all three sectors you mentioned, right? It actually is a strong regulated space. So for the startups, it's quite hard to start with. If you have a legit license, if you have a global coverage, that means you probably need to get licensed everywhere, at least in Europe or in US. So that has become like one of the hardest barrier to enter. That's why we see a lot of projects, but it's just not legit enough or like make us comfortable to invest at very early stage. Yeah.
And on the capital market side, I was just writing the show for tomorrow's Tokenized Podcast, and I was looking at CME's opening 24/7 trading volumes. I saw Coinbase have had Bitcoin perps approved, or is it Kalshi?
It's both.
Both. There we go.
Kalshi's got the US, and then Coinbase got the ability to offer their offshore to the onshore.
Yeah. And so I guess open question to you folks, like how big a driver is the 24/7 nature of this, and how involved and interested are institutions in it? You look like you want to say something.
I'm always a little bit conflicted by this in particular.
Well, this is good. This is good. Come on, open the can of worms.
Because, again, for us, our biggest clients are typically banks, right? Banks, institutions, but banks are very interesting because once you suffer through the pain and suffering of a year of integration and project work, lo and behold, all of their millions of clients can have access to regulated crypto, which is amazing. It's something quite unique that we are experiencing in this particular moment, right? These are universal retail or GSIB banks. But in any event, they are at the present, on the one hand, doing these crazy use cases where they offer the custody and the trading and the staking and the lending. On the other hand, a number of them, especially in the European Union, are really focused on a few use cases, namely tokenization, namely stablecoins. And when you start to really dig deeper and try to understand and evaluate what they're really doing, well, fantastic, now you have a euro stablecoin. 47 banks have signed a consortium and are doing it and facilitating various use cases like P2P payments and the like. How does that really translate to something positive for an end customer? On the stablecoin side, right, when all of these concerns really came from the US because there's 2 private companies that are destabilizing the US dollar, right? On the other hand, you have tokenization, which is a fantastic use case, right? The future that we have been promised was amazing. Tokenize everything. The reality for these folks is, okay, cool, you've tokenized the money market fund. And the arguments from an economic and rational perspective of, okay, you increase the velocity of money and the systemic impact that has, fantastic, but what really does it do for an end customer and user? And this, to me, is a little bit the conflicting part. It's amazing that they're venturing into this space, but I feel like they need to be much faster. And these are the first inklings that show us that there is a big transition happening.
Wait, who needs to be faster?
Much faster.
No, who needs to be faster?
Europe.
Oh, Europe? Well, that's always true about literally everything.
No, but I do think that is a point, right? Like, as someone who lives in London, going to the States, the kind of conversations, the energy, the speed is a totally different ballgame. And I think, there's the revision of MiCA coming. There's, I think crypto asset legislation in the UK being promised for 2027.
MiCA is an awful piece of legislation.
Sure, but
and it's really bad. And the FCA has never been particularly quick moving.
Sure,
right?
But like you're kind of emphasizing my point, right? Like the speed and the use cases, the investment, the talent is all in either the States or in Asia right now, and I think that's or in the Middle East, and I think that's reflective of the kind of regulatory frameworks.
Yeah, I think at the end of the day, like stablecoins are just tokenization of US dollars, right? And then we're talking about, okay, well now we're tokenizing all these other assets. Well, what we're actually doing is we're exporting US capital markets and exporting US dollars to the rest of the world. Like that is like what this business is happening, is doing right now. The ability for us to have also a euro stablecoin and for there also to be interoperability with global FX markets on a tokenized 24/7 basis, that's important, right? That's going to be happening across. I could go on an aside about the currency Cold War I think is happening and all of this stuff, but I expect that we're going to continue to get tokenization of other major countries, G7 type countries, because you're going to get into a world where a lot of capital markets are happening in a tokenized fashion on chain. Now, the reason I think that is because it creates GDP. And if it creates GDP, people are going to want to do it. Like that has always been true. Growth is just the winner. Money is the winner of all things. Now, do the banks want to do this? Like, no, but the banks are about to lose that war in the Senate in the US. And if the banks lose that war in the Senate in the US, like it's going to happen in the rest of the world too. I do expect, to your point around, you asked an original question around 24/7 trading, which I don't think it got answered. But to go all the way back to that, like it's very clear also if you go and talk to, I spent a lot of time in DC, and so you go and talk to Chair Seelig or Chair Atkins on the SEC side, that like there's an expectation when you talk to the big global trading firms, they want to be able to do 24/7 trading because it's more money. They also believe that you have to have tokenized collateral that can get moved on a weekend outside of banking hours to be able to do that in an appropriate risk managed way. And so if that is true, and if the U.S. government supports it, and the U.S. government goes on to tokenized rails, the rest of the world will follow. Like that's the reality of the situation.
Just take us about 5 years there. So.
Yeah. Well, I can definitely add, what's happening, in the Middle East or in the UAE specifically. The government in the UAE is explicitly, requesting that the National Stock Exchange move from this sort of 5 days a week, 9:30 to 4:30, model, which, they had followed from NYSE and NASDAQ. And, NASDAQ, CME, ICE, etc., they all understand that this is an opportunity for them. I don't think they view it as a challenge. It's an opportunity for them to expand their market access and also to make sure that price discovery happens on their venues and not on, let's say, crypto native venues, which
I think it depends on which one you talk to.
Yeah,
but,
yeah.
I do agree with you. ICE sees it that way.
Yeah, some people, let's say, some people. But certainly
Terry Duffy wouldn't agree with you.
Yeah. That's right. But for example, in the UAE. They have a broad understanding that, hey, if we can build the national stock exchange, on tokenized rails based on blockchain with high speed and low latency, well, why wouldn't we do that? We could. That means it could plug into a lot of markets around the world with the collateral mobility that Rob mentioned. That would make it interesting for very large, not only HFT firms, but very large asset managers to participate in the domestic market. So that they're all for it. Yeah.
I wanted to kind of move us to maybe some of the areas that have been under-discovered, under-explored, either from kind of what we're seeing in the public, but maybe what you guys are seeing behind closed doors, either like partners, but also in deal flow. So I think there's been a lot of energy, excitement, capital towards stablecoins and payments. Rob, I know you've invested in FX businesses as well, on-chain FX. Where next on the institutional side?
Yeah, so obviously I think all of us have done a bunch of, or for the investors on the stage, have done a bunch of like stablecoin payments type businesses, and we continue to see that as a focus. I do believe that the stablecoins, when I said earlier, are basically just tokenized dollars. They're sort of the digital oil of what will be, I think, an on-chain economy for all sort of tokenized assets. And so the amount of just innovation we'll see, like in broad capital markets coming on-chain, is probably that next phase. Obviously, to Alice's point, we're also seeing a ton of agentic or AI crypto stuff. Most of it's complete horseshit.
You sound so bullish on that.
Yeah, well, listen, I'm very bullish on agentic commerce generally. I'm very not bullish on the vast majority of what people talk about right now. Mm-hmm. And when people talk about stablecoins being required to be able to do agentic commerce, it's complete bullshit. And like, it's either you're not thinking from first principles or they're just pumping their bags. But there is going to be, we're all going to be doing a bunch of stuff with agents, and I think that's like inevitable. But that's probably the next stage of institutional adoption. I think the tough part about the capital markets piece is that how much value does it accrue to startups versus the incumbents? And I think that is still very much a wait and see.
Yeah, and to that end, we have a lot of startups out there who are trying to challenge what has been the domain of large FIs and banks, but I think a lot of them will find out the hard way that the game is not complicated, but there is one very critical factor which they haven't realized, is that it's a balance sheet game. And a lot of the startups, that we'll see don't have access to the balance sheet, and eventually,
Can you elaborate on that for people in the audience?
So for example, I think custody is a great example. Like one of the first examples where that happened, where custody in like 2018, 17 was a venture backable like business, because we needed custody infra, and very few people had it. But like with a lot of things, and not only in crypto but in technology in general, the price of the personal computer relative to the capabilities that you acquire when you buy one has exponentially gone down, since they were released. Custody is kind of like that, because I think in a lot of ways, custody is seen as sort of it's the checking account. You put your money there, but banks don't make money on your checking account. They make money on your auto loans and credit cards and mortgages, the value-added services that are stacked on top. I think, if you have access to large balance sheet, which means large customer deposits, large AUM from money market funds, you will find that will be the only way to survive, because these margins will compress over time.
Yeah, to add on to that, I think it's a great metaphor, as in like some of the startups, what they do probably cannot make a sustainable cash flow, right? But another thing, if you look at it right now in crypto world, we already have a lot of cash cow businesses, especially for exchanges. And from that point of view, exchange also wants to expand their new products and adopt to AI trading, technologies. even for us, we develop in-house, we will also evaluate whether it's nice to just acquire some startups that's doing great, and then we incorporate that. Even the company is not making money, is a good feature for our user to use. So it's a nice integration for the two companies. So I think that would be a interesting way to we see the investments going. So there will be more acquisition happening for those new startups.
Yeah, and Rob, very correctly mentioned agents, because in late 2024 there was an explosion of like new agentic trading startups, agentic payment startups. But from at least from my opinion and from my own discussions with people who are involved in agentic infra, the real big winners are probably not going to be like very small startups trying to do agentic payments. Because they lack one really big thing, which is distribution. One of the things that agents will be able to do is they will be able to make payments which are in fractions of fractions and fractions of stablecoins or crypto. It will be very hard to charge a lot of money, for that. So I think what will happen is you will start to see non-crypto players who have the technological capability to build enormous agentic rails, like Visa, MasterCard, Google Cloud, and Google, Amazon, AWS. These are going to be the challengers that will enter the market that startups have to be aware of. Yeah.
Stripe is the biggest agentic payments business in the world today. There's $40,000 a day of payments on X402, right? So it's like this is very, very small today. I would say, not to be too bearish on it though, like I think it is very clear that a lot of commerce is going to be done through agents in the future, both from a business perspective and a retail perspective. Stablecoins will play a role in that for certain use cases. It's going to be multimodality. There's a lot of ways that you can do metering. There's a lot of ways that you can do like one-time use tokenized cards, and you can actually just use a different, essentially just a different payment mechanism, or it can be a different payment token within like the acquirer itself, and you can just actually charge lower interchange because of that. It's a bunch of things that are being worked on right now. It won't just be stablecoins. Stablecoins will play a role though, and it'll be multimodality for whatever works best. I think there's also maybe a sci-fi question here, which is that like if we believe AGI is coming, then why do we think that if these things are going to be so smart, that we'll use something that we made? Like why wouldn't they just make their own thing? So, but this is like a much further down the line question, but a thing that I think about as a VC who thinks about things in years versus
that keynote's at midnight after a few drinks. If anyone wants to listen to it, I was going to touch on that note. Is the multimodality thing? You have to look at it from the merchant's perspective, right? Like, you wouldn't only take one modem of payment as a merchant from an agent. Like, you just wouldn't. So why would you not take in the same way that a human would pay for something from an agent?
I mean, we're in an unannounced round. We're investing in a company that kind of does agentic infrastructure, and they're, as far as I can tell, the biggest agentic payments, pure play agentic payments business in the world right now, and they do like $5 million of revenue. And so that's how big that space is right now. Obviously Stripe and some others are doing things there. And like the demand they've seen right now is, okay, well, occasionally there's stablecoin demand, but also they can do a lot of this through FBO accounts, and they can do with different types of like bank-to-bank transfers, ACH, et cetera. Like it doesn't need to clear, simultaneously. And there's a lot of this work is being done. Actually, Rain, who I talked about earlier, which is a port co of ours, they have a number of people doing one-time use virtual cards with tokenized credentials that are for the same thing, right? And so it's going to be a situation where certain things are going to make more sense at different times.
Wanted to see if anyone in the audience has any questions, since we have about 10 minutes left. Any hands? Any questions from the audience? No. There we go. 2. Okay. Could you give them the mic, or do I have to? No. Oh, there we go. We've got a Roma. That's great. Just in case they're recording it.
Test.
There we go, test.
There we go. Yeah. I was just wondering, like Rob mentioned that MiCA is a terrible legislation. So why do you see that, and how is that different from what's happening in the US or in the UK, for instance? Like, where do you see the difference between those legislations?
Yeah, so the MiCA collateral requirements make issuing a stablecoin here to be a very bad business, right? And that makes it very hard for there to be innovation around wanting to do more and more work here. The reason that Circle has still invested in the space is simply because they see it as part of their global network, but it's a big actually drag on ROE. And so it makes it very hard to want to keep a lot of collateral here and to grow your European business. So it disincentivizes the US issuers of investing in the EU in the same way.
But just to add those situations where it's not always about US issuers in the EU.
That's true.
For many of the European counterparties, you're legally allowed to be a custodian of crypto. That is amazing. Throughout private banks to universal banks, this is what this legislation gives. And yes, without doubt, it's imperfect. In particular to stablecoins and tokenized assets. But I think it's a good starting point for the EU to continue to export its biggest export. It's a legislation across Europe, but also to enable these large counterparties to have that legal certainty for many of the startups, SMEs to actually start servicing them being able to get the know-how and learn how to actually participate in the value chain of digital assets. It's a good starting point. It's not that bad. It's not perfect, but you know, it'll get better.
I firmly agree it'll get better.
Thank you. So my question is actually a continuation of Ellie's question. And from the perspective of, obviously, the policies that are different in different geographies globally, I'd like to have your take on what's going to happen in the US as, you know, not only from the perspective of innovation, but also how the market is going to change versus Europe, and also the same in Europe. And not only from an American perspective, obviously, but also from, you know, from the markets within.
Do you want to start with the US?
So is the question like how are policies going to change, or how?
No, the market itself.
How's the market going to change?
Yeah. So
Yeah.
what like innovation versus like which direction is it?
Yeah. So, and I'll try to answer exactly what you're asking, but I think what we're seeing right now is, so I mean, Europe is a fantastic payments. The amount of payments innovation that's happened in Europe is a fantastic place to happen in payments innovation previously. But we've seen a significant amount of more investment on the startup space in stablecoin related payments in the US than we've seen in Europe recently. And I think that is because of the fact that MiCA has made it very hard for people to do business here. And the Genius Act is, well, a lot of the Genius Act is essentially, you know, it has to go to rulemaking, so it passed legislation, and then you need the OCC and Treasury to go and actually figure out how they're going to enforce the rules. But we've seen a lot more excitement out of the US, and so we've seen a lot of startups and innovation brought back on shore. And I expect that that'll continue with and the Clarity Act will be helpful. I don't think it'll matter as much, but it'll be helpful for the tokenized asset side, which I think those are intrinsically linked. There's more risk in the US, though, in terms of the fact that the Democrats are likely to take the House in the end of this year. And the role of crypto and stablecoins has become much more politicized in the US than it has had in Europe. So it is certainly possible that there's this, what is it, like the rabbit and the turtle situation happening here?
Hare and the tortoise.
Yeah, hare and the tortoise. So. And so I think that plays in Europe's favor. I wouldn't discount the fact that there is a lot of innovation happening in Asia right now, and you know, Asian markets are significantly more digitally native. Alice is, I think we're of similar age, and she grew up with digital payments in a way I never did, because it just wasn't a thing in the U.S. And the way that the Asian fintechs have embraced, you know, digital payments, and then the things that we've seen happen in stablecoins there, I also think. We've also, from a demographic standpoint, we've seen a lot more. I actually think Africa to Hong Kong is probably the fastest growing, cross-border market right now in terms of business payments. And so I expect we'll see a significant amount coming out of there. I think there's real risk of this, like, we're exporting the U.S. dollar, but maybe we're, losing, from a more geopolitical sense, U.S. The U.S. is probably weakening a little bit in terms of the eyes of the global economies.
Comes, for example, to what the market will look like. Citing, for example, the one of the top guys of Citi. He mentioned in a chat that 30% of the money in the US is in the hands of the banks, versus Asia, I don't know any numbers about, but versus Europe has, let's say, 90% of the money is in the hands of the banks. So the market dynamics are very, very different.
Yeah.
And starting from those market dynamics, the legislation is made, and then certain changes in the market will happen. And that is actually also the part of the question, like, how do you see, what is next in these markets?
So that's helpful context. So, like, in terms of, like, for that specific point, we've seen a pretty big trend, both globally. This is happening in Europe as well. Is that the correspondent banking system continues to lose share, and it's losing share for SMBs. It's losing share for retail. I expect that to only accelerate, right, with stablecoins. That's going to be true everywhere. Well, you've seen the fastest growing type of payment out there is A to A, so it's account to account. Today, WorldPay comes out with a nice report every year that talks about this. And so we've continued to see more transactions happening account to account. We continue to see more transactions happening outside of the correspondent banking system. While the banking system here is very different than the banking system in the US or in Asia, I expect more and more of it will happen in the hands of innovative technology companies versus the banks themselves, and they will continue to lose share.
Any comments on the European side of things?
We're Swiss, right? Or I represent the Swiss bank, so we're in between. We're neutral. Everything is good for us. No, but jokes aside, it's really hard for me to qualify, right? I think the biggest issue that I see with our particular counterparties is the Basel requirements and the RWA treatment, wherein holding the crypto asset in whichever qualification you want for accounting purposes has such a punitive impact on your business, on your balance sheet, right? That you just cannot facilitate the business case, right? To your point about lending, it's just impossible to do a business around that.
It's 12.5x, right? Correct. Yeah.
Well, it depends how you count, right? But like, I mean, officially it could be all the way up to that amount, right? Whereas if you look at Swiss banks, for example, I mean, it's off balance sheet. How fair is that?
Yeah, and it's a good point. I used to work at Standard Chartered, looking at digital asset investments, and one of the big issues that we had was, let's say the bank let's say the bank's core business is lending, right? And so they're interested in investing, in a lending protocol and maybe putting, some balance sheet to work as TVL to support, the lending protocol. Oh no, you can't, because it's consolidated on the bank's balance sheet. So if you have any kind of crypto exposure, you need to furnish up to 50% against that exposure. Even if it's low volatility exposure. So it just completely nicks the idea of banks trying to participate in innovation. And I know that there are meetings of the Basel Committee which are going to happen later this year at revising that requirement, but it's still a big lift, yeah.
And that's also to say that I'm definitely not qualified to talk on the topic in any way, but that is just one symptomatic issue versus what is happening in the US, right? There's a lot of other elements across the different use cases, stablecoins, tokenized assets, where it's just painful to do business for qualified or regulated, semi-regulated entities across the European Union, let alone taking into account, I just came back from the Nordic Blockchain Conference. I mean, there is no retail market per se. Because, I mean, the tax treatment of crypto is ridiculous, right? You get taxed on the way in, you get taxed on the way out, and you have to disclose everything to the level where it's much more efficient for you to hold ETPs and ETFs. It's funny, right? I mean, ultimately, it's a decentralized technology that you should just hold on your own wallet and not, get taxed. It's a little bit contradictory and paradoxical. But I think these are really the anecdotes that shape the difference between a US and the European approach.
Maybe time for one more question, if anyone has one. Nope. If not, where can people find out more about you?
Online.
At?
Sygnum.com.
On the internet.
Go again, sorry.
Yeah, it's sygnumbank.com.
Robbie?
Yeah, you can visit us at further.ae.
You can visit our website, and also we have Twitter, and I have LinkedIn, so feel free to connect.
Yeah, Twitter, my last name, @Hadick M, for Matthew, my middle name. And LinkedIn, we also, dragonfly.xyz.
Yeah, X and LinkedIn for me, or tokenizedpod.com. And thank you very much, everyone, for watching. A round of applause for our panel.